Thanks everybody for joining us. Yet another month of the Canary Digital Fund webinar for March. We have titled this one Chaos Comms. In February, it was all chaos. Now we are starting to slow that down. So first of all, again, thank you so much for being here. A little bit about what Josh and I do. Our fund strategy is it's an actively managed crypto fund that focuses on crypto, but instead of other types of hedging strategies, we use bonds to hedge out a lot of our risk. So oftentimes we will move into bonds if we see a lot of chaos. And but other than that, we are also looking at opportunistic opportunities in both securities and assets that are related to crypto. We might even buy things like MicroStrategy or Schwab or Bitcoin mining companies. And then, of course, like I said, in bear markets and times of extreme volatility, we may move into bonds to sit it out. But moving on. Of course, Josh and I, we have both spent a lot of years trading and managing crypto portfolios. Previous to that, I spent quite a bit of time managing bond portfolios, which is why we leverage that expertise in our strategy here. And let's go ahead and move into the macro side of things, and then Josh will move us into Bitcoin and alts. So first of all, in the macro discussion, we want to talk about rates. So everybody in crypto has become rate experts. If you look at the probabilities that we have here based on the market, we tend to think a little differently sometimes. Our expectation is that there will probably be close to 3 cuts this year. We will likely get our first cut this summer, with a couple more in the fall. Some of the reasons that we believe we'll have this many cuts, and again, things can change, but inflation has certainly cooled down, mainly because people don't have money to buy things from previous inflation cycles. We jokingly say that the cure for high prices is high prices. But the probabilities show that it's probably closer to 2 rate hikes. But we certainly think that the administration is going to have more. So there's 2 mandates of the Fed: controlling unemployment and controlling inflation. Inflation has come down enough to where it's at a good place. Unemployment is still pretty low, in my opinion. I hate saying this, but I would like to see unemployment higher. The natural rate of unemployment should be around about 5%, and it's been sub 5% for years. And when you've got unemployment this low, it does typically lead to higher prices and lack of labor, particularly skilled labor in the workforce. So hopefully, we will see higher unemployment, but CPI, we also see lower CPI, which we believe that we'll see both of. One of the things that we always look at here is interest rates on a global level, and what we're seeing is that global rates are actually declining overall, which means that a lot of countries are seeing some form of recession. We've already seen recession in China. We've seen it in the UK. There are hints of it in other EU countries. But overall, we are seeing a downtrend in the global economy. And I believe that trend is going to persist. Not to be too discouraging, but we're in the 15th year of a bull cycle from a global macro perspective, which is a very long time to not have a pullback, both in the U.S. and globally. And we believe that's coming very soon. Of course, that coincides with the 4-year cycle of Bitcoin, which we will likely come to the end of at the end of this year, if history repeats itself. And 2026 could be a year that everything goes down. We're already seeing hints of that again, with equities, with bonds, but we do believe that crypto will continue to go up this year. Other than interest rates, U.S. inflation, like I mentioned before, continues to decline. It's getting much closer to the Fed's 2% target. Now, the Fed doesn't always try to target exactly 2%. They actually just want it to be below 3%. And we're already there. So if historically the Fed has liked 2 to 3% inflation, and since we've already gotten into that range, we're in a range where rate decreases are extremely possible. Probably not at the next meeting, but maybe the following one. As far as the Fed goes, despite inflation being in the range that they want it in, they want to see the effects of the tariffs. So we don't believe that the Fed will look at data earnestly until after April 2nd. But we do believe that April will be a pretty good time for markets to begin to go up. Of course, as I mentioned, unemployment is still below 5%, still at historic lows, despite Doge cutting jobs in the government. It gets all the headlines, but there aren't enough cuts to be had to significantly impact unemployment to get it above 5%. And to really explain where we believe the extent of the cuts will be is there's government jobs that are being cut. There are people that are being paid to go away. But there's also a big impact to NGOs and other businesses that are heavily tied to the federal budget. And if we do get a decrease in the federal budget and in spending and in cuts across government, we still don't likely see enough to drive unemployment even to 5.5%. Likely, those unemployment will be driven a little bit more by tariffs. So we'll see how that goes, but unemployment we do expect to stay low, and low being below 5%. As far as the dollar goes, we have seen weakness post-inauguration, of course, and it's not too far off from what we saw in the first Trump administration. Dollar weakness, we do believe, will continue to persist, and of course, that has a pretty profound effect on bonds, which we're watching very closely as well. We, back in December, noticed that the yield curve uninverted. There are some areas of the curve that are still inverted, but overall, it continues to be uninverted. When the yield curve uninverted in December, it did it in a way that gave us a lot of concern over where pricing was going to be in 2025 and where the economy was heading. It was primarily due to the fact that the long end began to rise while the Fed was lowering rates on the short end. Now, that's actually healthy in one way, but in another way, it does show that there's short-term risk, which we're seeing, and then we likely come out of it later, which is 3 to 5 years. Short-term risk is likely occurring in 2026. But the issue with the 10-year going higher, and I do believe that the 10-year is on a trend going higher. The end of the generational bull market in bonds was in 2016. And even though we have gone lower in some cases, such as COVID, those are anomalies, and the trend is higher. So we do expect, even if yields come in, which I do believe they will come in 2025, the long-term trend of a generational bear market in bonds will likely to persist for at least another 15 years. So if yields come in 2025, like we expect it to, go out and buy that house you've been waiting on. It's going to be the lowest mortgage rate you're going to get for a while, and sit on it. Many people who got mortgages back when rates were below 3% are holding and will probably continue to hold. Why sell your house when you're getting, 2 3/4, like I have, when you have to pay north of 6%? It will likely cause a slowdown in housing, but not a downtrend in housing like we had during 2008.
And I threw the 10-year 3 month on here specifically because if you listen to Cam Harvey talk, who was like the creator of this inverted yield curve metric, he will tell you that his preferred measurement is the 10-year 3 month curve and not the 10-2. The 10-2 gets a lot of headlines, obviously, but just interesting that it went back negative before we're getting a recession here. Because again, he'll tell you the 10-year 3 month, I'm pretty sure has a 100% back tested hit rate as far as predicting a recession, which is possible going forward, obviously.
Yeah, that's right. Yeah, I mean, yeah, 10 3 month is always the signal of recession. 10 2s is more for bond traders and how we look at the market.
I threw this in here.
All
So
right,
this is
I'll hand it over to you.
so this is two GDP estimates from the Fed. Just an odd anomaly here because we've got the Atlanta Fed saying that we have this negative GDP print, which is mainly due to the gold imports that we've had recently. In the model here, it gives us, even today, we got an updated negative 1.8%. If we include the gold imports, if we adjust it based on their model, we get somewhere around 0.2 to 0.4% today. And then if you ask the New York Fed, they seemingly give you a 2.72% number for Q1 GDP. So even the Fed is in disagreement here. You'd think they talk to each other a little bit, but I guess it's just different models as far as what they're looking at and which data they're looking at. But I think this also speaks to the uncertainty because we're getting these headlines off of the Atlanta Fed GDP print. And there's some room here for a surprise to the upside if whatever the print ends up being for Q1 GDP, if it is more positive than expected, then I think that would be welcomed news for risk markets. And of course, everybody's hyper vigilant and focused on this April 2nd tariff outcome. We're getting like dripped expectations of tariff stuff. A couple days ago, it was the tariffs aren't going to be as bad as expected. Now it's who knows what. We could have intra-hour tariffs where there's some agreement that comes to within the announcement on April 2nd. So obviously it's less about like the reality and more about how does the market react and what are the downstream effects. I think the goal here is lower the government deficit, investment in the US and onshoring. But if we don't see that, if we see the opposite of that, if we see delayed investment, if we see bigger reciprocal retaliatory tariffs between countries, then we've leaned towards reinflation, stagflation, rising unemployment, as Stephen mentioned, recession. That's where crypto specifically is unlikely to do well in that environment. So very much a wait and see. And I think the issue here is that the expectation of outcomes is so wide, it's very hard for anybody to do anything in earnest until we sort of know what's going on, right? Because there's Like you could tell anybody that any of this stuff is possible and they'd believe you. We just don't know, right? So there's still lots of uncertainty around that. And on the back of that, if we compare previous years where there was a bull market and a post-halving year for BTC, 2013, 2017, and 2021, and we look at the macro conditions, the money supply, the dollar, the S&P, we don't need like 2017 where it was just smooth sailing. We don't necessarily need something like that to do well, where rates are low, CPI is low, unemployment is low, they're expanding the money supply, the dollar's going down, the S&P closed the year plus 20%. We don't need that necessarily to do well, but that's the type of environment where we would do best. I think both Stephen and I think that the ultimate, the best environment is probably the least likely, but that doesn't mean we can't continue to do well here in 2025. And if we look at the numbers at the bottom of this table for 2025, we're obviously not really we're green where we need to be red and red where we need to be green, basically, right? We're kind of not quite there in a lot of these metrics just yet. And I'll get to it later, but we're still pretty correlated to tech stocks on the BTC side. For Bitcoin, there's an obsession with people trying to decide where are we at in the cycle. No one wants to be holding. It's weird, there's this mentality, hold on for dear life, and then there's this other mentality where we have these 4-year cycles and people understand we're going to have this massive down year because that's what we've seen historically. So there is a preoccupation with trying to figure out where are we at in the cycle? Are we in the first inning? Are we in the seventh inning? Has everybody gone to the parking lot already? Like, what are we doing here? So if we look at the previous 2 cycles, based on the cycle low, we are currently between, let's say, 850 days past the cycle low. And that puts us in the later stages of the 2022 rally, and we'll say the mid to late stages of a 2017 rally. So it really depends from here, obviously, where we go. But up until now, we have been pretty tight relationship wise with the previous 2 cycles. We've even had variations where we're deviating and we snap back, right? So that's still possible here for this cycle. So I don't think it's fair to say that the cycle's over just yet. I think we do have some potential still in us. And if we stack up all the 4-year cycles and we look at, again, the expected outcome for this year is a positive return on the year. The expected outcome for 2026 is a negative return on the year. I, for one, would love it if the cycles just dissolve entirely and we can stop talking about this cycle stuff, but it is helpful to have a guideline metric. Just looking at possibilities based on the yearly open, a 25% move this year would bring us to 118 as far as a yearly close. I think that's reasonable from here. I was trying to game out what the S&P would be. I think that's like, what, 6,500 maybe? Um, we tend to be like 3x the NASDAQ. In other targets, 142, 165, these become possible so long as Q2 looks better again post tariff. That's going to be the deciding factor. How do things look from there? There's some technicals that I'll get to that are lining up that things could look great in Q2, but we have to get there and see it first, right? Like we're not quite where we were pre-election, where things on the technicals looked really good. Going into the tariffs, we're a little more wishy-washy in the middle here. If we look at the ETF flows for BTC and ETH for the past 6 weeks, 8 weeks, they've mostly been negative. We had a positive week last week. ETH basically can't catch a bid or attention. I just think it's hard to explain ETH to anybody who's not in crypto. What is it for? Why do I need this? why not just BTC? I think it's tough. Price is obviously a problem for ETH as well. It's got negative momentum. It's just keeps going down. And then on a relative basis to BTC, it's doesn't look too good. I'll get to that at the end, but it's important to see what the flows look like again into Q2. If we can get some positive momentum and some tailwinds, I would expect flows in the ETFs to pick up again, specifically for BTC. I think ETH is another story. Stephen and I were talking internally, like, will staking matter for the ETFs if it comes for ETH? It's possible, but you have to remember for ETH specifically, the more ETH that is staking, the lower the yield. Currently, it's around 3% yield. If the ETF starts staking, that could push it to 2%, right? Like, is that attractive at that point? I don't know. Maybe. But thus far, it's been almost entirely a BTC show on the ETF side of things.
Yeah, and speaking about ETFs a little bit,
Yeah.
there's still there's still a lot of financial advisors, pension funds that are investigating the Bitcoin ETFs. A lot of them have requirements on how long the ETF exists before they can invest in it. But there's still a lot of positive momentum and positive spin on Bitcoin ETFs, which is one of the reasons why we believe that a 25% increase in Bitcoin is not only the likely scenario or the most likely scenario, but probably more of the base case. We really don't believe it's going to go too much above 50% this year, but 25% is probably the bar. Just given what we know as far as investors that will continue to buy the ETF. The ETH ETF is largely frowned upon. A lot of again, financial advisors, pension funds, other institutional investors don't really understand ETH. The more they dig in, the less they understand. I would say I'm guilty of that as well. The more I dig in, the less I understand. I get more questions than answers. And there's not a clear narrative on what ETH is. Is it kind of like another digital gold? They tried that for a while. It didn't really work. Is it a truly distributed ledger? Not really. And what's happening is the confusion around ETH has turned off a lot of these investors. The last time ETH had an all-time high was about 4 years ago, and I don't believe we'll hit another all-time high in ETH, despite the fact that an ETF was launched. Now, to be fair, for what ETH actually is, in my opinion, which is a fast distributed ledger for things that's not money. There are a lot of chains that have come out to be more superior and have more usage and more projects being built on. And a lot of the institutional world is already skipping over ETH and looking towards things like Solana, for instance. Solana, SWI are the two big ones that a lot of people are looking at. On the enterprise level, they're looking at HBAR and XRP. The XRP lawsuit has certainly, being dropped has certainly helped what they're doing. So that's where people are looking beyond ETH. We actually believe that, again, a lot of these tokens probably won't hit another all-time high this year. We do have a firm belief that Bitcoin will. There's probably a few other tokens that will as well. We're actually in the camp that Litecoin will, as more of a silver to the digital gold. And the fact that an ETF for Litecoin looks very promising, and a lot of people understand it because it's essentially a fork of Bitcoin, even though it's really not. But it's so similar to it that it's easy to understand, and a lot easier to understand than ETH. So we believe that both of those will hit new all-time highs this year. Probably a few others will hit all-time highs. But we're also in the camp that Solana won't hit another all-time high this year. nor will ETH. So that's really where we're focusing our attention is, where are the institutional investors going? And that's really important to us. And Bitcoin still seems to be the best asset. And as far as the world of crypto, the safest with probably the best asymmetric type of risk return.
Yeah, the competition for ETH also just dilutes the investment pool there, the money, the attention, the developers. You've got at least 10 other competitors that are vying for the same eyeballs as ETH, and it's hard for it's hard for ETH to compete against that, against the
Yeah.
newer tech.
ETH is a BlackBerry, and there's like 10 guys making their own version of the iPhone. It's gonna be tough.
Correct. Just as we look at the ETF flows on the legacy side, on the chain side for Bitcoin, we can look at on-chain activity. So of all the on-chain metrics, this one's my favorite because it's kind of confusing when you first see it. But what we're looking at here is the number of coins as a percentage of the network that have moved in the past 6 months. And if we look at this compared to price, what you'll notice is all of the previous cycle highs have corresponded with a massive jump in on-chain activity. And this is likely because when you move coins, you're selling them. So if we see a ton of movement on chain to the tune of 80% plus of the network turning over basically in a 6 month period, that has marked the top in a cycle. What's disrupting the purity of this data going forward is going to be the ETFs because the ETFs, they're on chain, yes, but at the same time have this off chain activity from a trading perspective, right? We also have recently Mt. Gox being unlocked, government coins that are super old that are moving. We had the ETFs launch and we had a bunch of GBTC coins moving. We had a bunch of people selling their BTC and buying the ETF. So we have had spikes in 2024 and in 2025 in this data as far as the percentage of coins moving on chain. Those spikes have been less than what we've seen historically for cycle highs. And those spikes are probably more related to events than the price itself, but it's hard to say that in the moment. We won't know whether or not the high was in realistically, until maybe 6 months from now. But just looking at this, it's possible that despite these massive jumps in on-chain activity, that we've still yet to see the penultimate, cycle high related to on-chain activity. These spikes are also similar to what we saw in 2019, where we get this like mid-cycle peak, but not the peak for the cycle. On the technical side, this is where I spend a lot of my time for the fund and for fun, just looking at basically trend metrics here. If we do a quick cloud lesson, what you're seeing here, the colorful lines and the fill is called the Ichimoku cloud. If you're above the cloud, you're bullish. If you're below, you're bearish. If you're in the cloud, you're neutral. And what you'll notice today is we are on the underside of the cloud, so we are in bearish territory. This trend metric system works as a checks and balances, so it's looking for specific rules. Are we above the cloud? Is the cloud bullish? Do we have a bullish cross on the TK lines? So currently nothing is bullish, which excites me because going into Q2, if we, like we did going into Q4 last year, start to flip these metrics bullish, that is a very good sign that we will start to see bullish continuation and at the very least an attempt for an all-time high retest. So the line to watch here really is like 92K in April. If we can get that in April, then we're in a good spot. If we can survive the tariffs starting April 2nd, we're in a good spot. Zooming out a little more and going a multi-year level, if we just put a vanilla channel on price, this is specifically called a pitchfork, but if we look at where we are relative to the pitchfork, the midpoint, the extremes, we're about close to the midpoint, similar to what we saw in mid to late 2024. If you're a technical analysis believer, you also believe that price has memory, price is people, price is behavior. And so long as we can hold and maintain the midpoint of this channel, again, that bodes very well for price going forward, much like it did last year in 2024, where we sort of refused to break down from the channel. Things would look and be much more bearish if we started to break down and then had that ceiling as a midpoint versus the current floor. Obviously, that can change, but how it looks now is certainly more bullish than bearish, despite giving back 20% from highs, right? And then zooming in on lower time frames, just looking at things like chart patterns, this is very early as far as what we may expect. But if we look at the possibilities here, we're setting up for a potential triple bottom again going into Q2, which would be called an inverted head and shoulders chart pattern. Again, the neckline at around 92, 93. So if we can get above the previous support level, which hopefully is not resistance, then again, Q2 should be bright as far as an all-time high retest. We can also measure the depth of the current range, projected higher. That's how this works with technicals. That gives us a range of 104 to 112 on a measured move if we can break and hold that 92K level. So that's definitely something to put on the calendar for Q2. As far as the correlations, we get a lot of questions from TradFi folks. What are you correlated with? Are you just another tech stock? Are you the triple leveraged QQQ? And the reality is, over time, it changes. If you look at 2023, we were more correlated with gold than we were with equities. Since the election, especially after the ETFs launched, BTC and SPY, BTC and the Qs have been more correlated than correlated with gold. And post-election, there was a huge spike down for the BTC gold correlation, probably related to the regime change in the regulatory land, the expectations on strategic Bitcoin reserve, all that fun stuff that came with the Trump election. That probably helped push that correlation lower, but we're certainly acting more like digital tech, the digital gold at the moment. And that's going to turn off a lot of people. I agree. It's just important to keep an eye on this and see in what conditions will this change, right? But if you're bearish tech, if you're bearish legacy and equities, right now it's hard not to be bearish BTC until this relationship decouples effectively. If we look at the landscape of the top layer one assets, BTC in the white there, this was a few days ago, so it's up a little bit since then, but BTC in the white down 10%-ish year to date, and we've got alts down much more than that, specifically ETH down there, SOL down there, 30 to 40%. ETH and SOL down like 50% since November, December. And we sniffed this out early and avoided a lot of this stuff in the beginning of the year. And so now it's kind of a key time for this alt conversation, because will we see bearish continuation? Will we see price bottom out here? Will we see the beta, the Bitcoin beta, the leveraged Bitcoin plays, which are basically alts? Will we see those start to pick up again in Q2? Seasonality wise, alts do best typically in Q2 and Q4 of the year. So that's certainly something we're paying close attention to. If you look at the altcoin market cap in aggregate, it's called Total 2 on TradingView if you want to ever pull it up. It currently, again, back to our cloud lesson, it's currently below the cloud. It's currently in bearish territory. It has what I'd call a falling wedge variant on the chart here, similar to 2024. It's kind of a hallmark of legacy, sorry, not legacy, but hallmark of retail traders, just this downward puke, right? You tend to see this a lot. It's also related to the coin emissions and inflation of alts in general, but similar to Q3, Q4 last year, if this can start to bottom out, then yeah, we can talk about alts starting to do well again, but we're just not there yet. It's a little too early. Something else to pay close attention to here is the stablecoin issuance on the top there. We've seen, I think, over $1 billion issued in the past week on stablecoins. A stablecoin bill from the United States, which is likely coming here in the next couple of weeks, may help just explode what stablecoins are in a good way and allow for more issuance of stablecoins. Thus far, we've seen a lot of that going into altcoins. So if we see a 250 billion circulating supply of Tether and USDC, that probably means altcoins are doing very well. So that's just something else to watch in Q2. And another part of the focus of the fund is the relative value of alts versus BTC. And as Stephen hinted at, with brand confusion for alts and just dilution and a lot of competition there, that has really helped BTC continue to win because it is a singular message that, for the most part, everybody understands. And if we look at total two, which is the altcoin market cap relative to Bitcoin, this has been basically down only since 2022. So because of that, majority of our positioning certainly is not in the altcoin market. It's on the Bitcoin market. And again, if we start to see activity on chain, if we start to see ETF flows pick up, if we start to see technicals more positive relative to Bitcoin, then it would make more sense to be allocated there. But as a group, it just does not make sense based on technicals. Still very, very bearish here. And the last time we were down here, it took multiple years to finally bottom relative to BTC. It also took COVID stimulus. It took ZERP. It took the kitchen sink for alts to really do well. If we isolate ETH specifically, ETH probably looks the worst of most of them as far as the majors are concerned against BTC. And again, it's black or white. It's a litmus test. Are you bullish or bearish here on trend metrics? You are very, very bearish. Continuously bearish here since 2022. And it's almost to the point where it's bad enough to buy because it's so oversold. It's just there's very little fundamental evidence that this is going to turn around. So it's hard to want to take the trade. And I think that's where a lot of people are because of all the reasons we've stated. Tons of competition. And if we look at the on-chain activity here, active addresses on ETH have been ranging for a while and are going lower. So that's just network activity. And for ETH specifically, there's a burning mechanism, which I guess you can think of as like a buyback mechanism for legacy. That is flatlined. So the burning mechanism picks up as the activity picks up, and it falls off as the activity falls off. And if the burning falls off, you have more tokens in circulating supply, and it's just all negative, right? It's this flywheel of negativity for price. So that has helped push ETH lower, along with all the competition that we're seeing relative to ETH. So our focus still is mainly BTC, mainly not alts. We will be there if alts start to look better. It's just they haven't. They really haven't. And individually, we like some longer term plays for alts, but as a group, it just hasn't really made too much sense. And on that high note, if you want to contact us or get a hold of us on the fund side, I'll leave this slide up for a second. And Stephen, any final parting words here?
I have none, Josh, other than we're still bullish this year, 2026. we're bearish.
Yeah, and that could be wrong too, right?
Could
That
be wrong.
what would be interesting is if, hey, what if 2025 is bullish, or sorry, bearish, and 2026 is bullish? It wouldn't really make sense, but you know, again, we'll be there. We're not like dogmatic where this is what we're going to do no matter what. But yeah, that's certainly the expectation. All right. Well, thanks
Well,
everybody for stopping
yep.
by on the live or recorded version, and you can join us next month for the next webinar.
Thank you, everyone.